what to do, either as full-time or add it up to what you're doing presently. Okay. Now, we're going to be starting with the first course will be Fundamentals of Investment Banking. Fundamentals of Investment Banking on the screen. Fundamentals of Investment Banking. So this will take us through a little bit of introduction of what investing banking is all about and what you need to be to become an investment banker. Okay, so to kick off, I'm going to play 2 videos in succession for you. Please, you need to start right now. These 2 videos will introduce what we're going to be doing in this course. The first one is what is investment banking, and the second one is who is an investment banker. All right, so before I start, can you sit back? Let's watch this video.
Okay. Why is it so lucrative, and how do banks differ from commercial banks? Before we explain how investment banking works, let's turn back the clock to see how it all began. From the early 19th century, commercial banks in the US performed the functions we now associate with investment banks. But during the Civil War, this all changed. The tale of investment banking begins with Philadelphia financier J. Cook. No, not that kind of Cook. In 1861, Cook established the first ever American investment bank to help fund the federal government's war efforts. As such, the US government became one of investment banking's first clients. Back then, the government had to issue bonds to raise enough money to support its rapidly growing economy and complete infrastructure projects like building the railways. Bonds are like IOUs between lenders and borrowers and are typically used to finance expensive projects. In many cases, investment banks would buy these bonds, then sell them on to private investors for a profit. Today, investment banks practically do the same, just with different parties involved. The question is, where are those billions of dollars in revenue coming from? Well, the business model is actually pretty simple. Investment banks purchase assets that hold monetary value, otherwise known as securities, and then sell them on to third parties for a fee. This process is called underwriting. So why don't clients and investors just save money and make the deal themselves? One of the biggest perks of making this kind of deal is that the middleman is responsible for distributing the securities. If they can't find enough investors, they have to keep some securities themselves. When you think about it, investment bankers are basically risk-taking middlemen between clients and investors. Now, this isn't exclusive to investment banks. Commercial banks take on risks as well, but here's where the difference lies. Commercial banks deal with individuals and small to mid-sized companies, giving out smaller sums of money like individual mortgages and small business loans. They make their profits through the interest they charge. On the other hand, investment banks take much larger risks. They deal with huge companies and high-risk startups, acting as a bridge between companies and investors. In the process, they can earn a huge amount in fees. All of this sounds great in banking. Why is it so lucrative?
Okay. That's just a little introduction to investment banking. So the next video I want you to watch is who is an investment banker. Like I told you, please make notes. Everything you're going to see in this video will form the basics of everything you're going to learn. Okay, so let's watch the next video.
Hi, everyone. In this video, we'll discuss one of the most exciting careers in the finance world, investment banking. Disclaimer, we'll try to depict this job opportunity in a more realistic way than Hollywood movies. Believe it or not, this isn't the typical day at the office in most Wall Street firms. Instead, we'll consider what investment bankers do on the job. how they fare in terms of salaries, what skills and academic backgrounds are necessary to become an investment banker, and how to get a job in the field. But before we begin, please note the following notable entry-level career opportunities in the field of finance, including financial analyst, financial controller, investment analyst, Big Four advisor or auditor, VC analyst, private equity analyst, and investment banker. We'll make a video for each of these other career opportunities, so please subscribe to our channel to check them out. All right, so what do investment bankers do? The four primary areas of investment banking include capital markets, advisory, trading and brokerage, and asset management. Your job description will significantly vary depending on the specific area of employment. The capital markets division helps companies raise funding by selling equity or debt to the public. In the case of equity, we speak about equity capital markets, ECMs. And when an investment bank helps a company sell the debt to the public, we talk about debt capital markets, DCM. The focus of advisory are M&A deals and debt restructuring. M&A stands for mergers and acquisitions, when companies wish to merge or acquire each other. Investment bankers assist in this process. Sometimes they're even the engineers behind the deal, advising clients on which companies would make good acquisition targets. Besides M&A, investment banks' other advisory services are related to corporate distress. A restructuring process is when a firm cannot service its existing debt and is in danger of going bankrupt. Trading and brokerage is an investment banking business line that involves purchasing and selling securities by using the bank's money or conducting it on behalf of clients. And lastly, the fourth investment banking area includes asset management, helping clients with investment management and strategic advice. The aim is to support clients in achieving their financial goals. We'll discuss these investment banking business lines in our comprehensive investment banking course. Okay, great. Let's pick one of these areas. For example, M&A, and describe what an M&A investment banker does on the job. An M&A investment banker would be expected to analyze companies, understand their financials, research potential M&A opportunities in a given sector, and create pitch books, which are then presented to clients. They will spend significant time in Excel working on multiples and DCF valuation models, which are then discussed with clients who are advised whether a particular M&A deal makes sense from a financial perspective. And when a deal does make sense, clients will engage in an M&A process, which is relatively technical and complex. This is when investment bankers coordinate different work streams and help their clients execute the deal. So investment bankers don't simply work on spreadsheets and value companies. They also build relationships with diverse stakeholders and manage different activities in the M&A process. This is a demanding job that assists individuals. Hi, everyone.
Okay. I hope you all enjoyed that video. This is just to give you an overview. Well, from what I've seen as your qualifications, I'm sure a lot of them are very strange for you. You're hearing a lot of finance words and terms you've never heard before. You don't have to worry. I'm not going to get into all these complexities until I'm sure you understand the basic terms. Okay, let's start by defining investment banking. What is investment banking? What do we mean by investment banking? So please look at your screen. You can see from the video you watched, it encompasses a range of financial activities primarily aimed at assisting corporations, governments, high net worth individuals. Note, corporations, government, and individuals. So investment banking is not just for companies. Raising capital, pay attention to that. Issuing securities, underlying securities. I know some of these terms are very strange, but I'm going to be talking about them immediately so that we carry everybody along. Then acting as intermediaries between users of securities and investors, employing their expertise in financial analysis and market knowledge to execute transactions effectively. Okay, so this is a definition of investment banking. Basically, you assist all these institutions, organizations, and individuals financially to achieve some basic objectives. Now, let me try to let you understand how investment bankers work. I'm going to illustrate, I'm sure you watched into the video, but let me just drive it home. All of you have accounts in commercial banks. So what do? You have GT Bank, Zenith Bank, Sterling Bank, and all the banks. You go to your bank and you deposit money in the bank. So what do you think they do with the money? What do they do with the money? What do commercial banks do with the money? That money, they give it out as loans, several kinds of loans, housing loans, business loans, commercial loans. And at the end of the day, they make interest, they get interest. So that's what forms a bank profitability. Now, for a bank to be profitable, the amount that they are taking to accept that money from you must be smaller than the amount they're taking to give out that money. So in that way, a bank remains profitable. So a commercial bank basically earns money from what? Interest they charge. Now let's look at it this way. You have a company and the company wants to acquire another company or wants to scale up or needs funding for something. They need money to do something. Now, what do? They don't have the money, or they have some securities to sell, or of any time, I'm going to come to all these steps. Now, let me just reduce it until I explain that to you. So what an investment bank is to be like a middleman between the two parties involved. They don't take interest. What they earn is a commission on this transaction. So look at the screen. Now, these are some of the differences between commercial banks and investment banks. So just like I mentioned, primarily services are for deposits. Then for these ones, these are buying and selling of bonds and stocks. So that's their primary function. Then their secondary services are overdrafts, promissory notes, cards, and the facilities. Then for investment banks, their secondary services include management, asset management, raising money for mergers and acquisitions, advisory services, and underwriting of securities. The commercial banks provide service to public. It's normal. Then investment banks provide services to investors, corporations, and governments. I've said it before, these people make profit through differences between lending and deposit rates. Then these people, their profit is through fee charges for services. For commercial banks, the risk factor is low. For the investment banks, risk factor is high. Then the commercial banks have a lot of customers. Investment banks have a lot of don't have a lot of customers. So I'm going to be giving you an example of this. So I want you to, this is just an overview for you to understand exactly what investment bank does. But to make it clearer to you, there are 7 major functions of investment banks. They have 7 major functions. Now, what are these functions? They include the following: mergers and acquisitions, underwriting, risk management, research, structuring and derivatives, merchant banking, and investment management. So this course will cover most of these things that I have highlighted for you on the screen. Okay. Now, for a typical investment bank, there is a structure. And if you watch the second video that I showed you, some of the opportunities you have in investment banking is also highlighted on the organizational structure, because these structures I'm going to show you now, people work there. So these are some of the things that you may choose as part of what you're going to be doing as an investment banker. Okay, so let's look at it. So we have the front office, we have the middle office, and we have the back office. So in the front office, we have investment banking, we have sales and research. In the middle office, we have research management, we have financial control, then we have corporate strategy. Then at the back office, we have operations involving data checking trades that have been conducted, ensuring that they are not erroneous and that the transacting the required transfers. So this is what the structure looks like. Okay, now I don't want to drag you into some of the investment bankers we have abroad. I'm going to also give you examples. So let's look at some of the major investment banks we have in Nigeria. Put it on the screen. So we have Afrinvest, Coronation Bank, First Bank, Nigeria Quest Asset Management, Invest One Capital Management, Renaissance Capital, Standard Chartered Bank, Chapel Hill, Denham, Don Lauren, Merrifield Limited, Greenwich Trust Limited, and There are a lot of others. There are a lot of others, as well as asset management companies. Okay, so now this is about investment banking. We don't have all the time, so what I will do is we're going to create a study page through Paragon. What we'll be doing is, if you have questions, you can send it down, then we can answer your questions. Okay, so now let's talk about you that is listening to me. Who is an investment banker? Who is an investment banker? Who do we refer to as an investment banker? I've already shown you in the video, and I hope you watched it. So it's a specialist involved in an intermediary in the merchandising of securities. You see, this word securities keep coming up, and I have seen from all your background. We're going to be talking about securities immediately after now. I want to really define all these terms so that we can flow as professionals. So he also acts as a middleman by facilitating the flow of savings from those economic units that want to invest to those units that want to raise funds. So these are your major tools. This is who you are as an investment banker. This is who you are as an investment banker. If you also watch the videos, they highlighted some points, but let me also bring it back on the screen for you. Now, this is some of the things you can be doing as an investment banker. Underwriting, distributing, advising, and others. Remember, we had this at the structure. We mentioned all this at the structure. So some of you that are listening to me, you need to make up your mind depending on what your proficiency is, the area you want to concentrate on, where you want to put a lot of emphasis on as an investment banker. Operations, technology, the risk management, corporate treasury, financial control, corporate strategy, and of course, compliance. Okay, so why do I want you to be an investment banker? What are the advantages of becoming an investment banker? So let's put it on the screen. So number one, investment banking is one of the world's highest paying finance areas. So as an investment banker, you earn a lot of money globally. It introduces you to high profile individuals and improves your reputation. It's just like some of these people who are doing real estate, you know, because you are dealing with high network individuals. It's usually easy for you to know people. Investment banking is a developing industry in Nigeria with numerous potential and opportunities. So a lot of people don't really understand what investment banking is all about. At the end of today, you will see all the opportunities, things you can do and start to earn money, even while you don't have a job, or things that you can be doing and it will be a kind of multiple stream of income for you. Investment banking now allows individuals to utilize and improve their professional skills while also providing first-hand knowledge of the investment sector. For those of you who will be into research, I know I've seen some of you here on IT, but when you get into research analysis, we'll be talking about that today in this course. You will see that it's going to improve whatever knowledge you already have. Those with strong verbal, analytical, and numerical skills might expect endless growth in investment banking. So here we're talking about skills. We're talking about skills. Some of you have been at home, you're not improving yourself. You must learn, build skills. Soft skills, technical skills, you can see it is clear there. Verbal, analytical, numerical, all these skills will help you as an investment banker. All right. So do you have any questions? Do you have any questions for this first introduction? This is just a quick introduction on investment banking. All right. Do we have any questions? Okay. We've spent quite some time, so we'll be moving very quick. Okay. Mr. Vitalis says it's clear that we should go ahead. Okay, so the next thing we want to talk about is, I keep on mentioning securities. I don't want you guys to get confused with these terms. So I want to get into it. So in the next few minutes, 2 presentations, I'm going to be talking more about fundamentals, some of the terms you need to grasp. So when I now start flowing, nobody will get confused. You can also write them down, so when you get home, you will research more. Every business has its own language. So in investment, in trading, there are things you must know. So these are some of the things I'm going to be talking about now. All right. So let us go with understanding securities and capital market instruments. Understanding securities and capital market instruments. So I need you to pay attention so that when I say, oh, they are buying securities, they are selling securities, they are selling, I want you to know what it is. So what I'll be doing in this present module now is to define some of these things and make it very clear. Okay, so when we talk about securities, what are we talking about? So look at the screen. A security is generally a fundable, negotiable financial instrument representing a financial value. So remember, it's a fundable, negotiable financial instrument representing what? A financial value. Security is a financial instrument, typically any financial asset that can be traded. So you need to watch the operative words. Fundable and can be traded. So it's very, very important. I want you to take this session seriously, because going forward, that's not, if I say 5 words, it must jump in. If I cannot say 5 things without these words coming in. So you need to really pay attention. So we have different types of securities. So we have equity securities. We have debt securities. And we have derivative securities. Again, we have debt securities, and equity securities. Now, when we talk about debt securities, what are we talking? Equity securities, what are we talking about? Equity almost always refers to stock and the share of the ownership of a company. Let's say you have a company. Now, those shares you have is what we call equity, which is possessed by the shareholder. I want you to understand this. So when we talk about equity securities, please, I want you to really understand these words. Probably Uche can be using them during trading, blah, blah, blah. You should know what they are. Now, they refer to stocks and the share or the ownership of a company, which is possessed by the shareholder, one of the owners of the company. Now, equity securities usually generate regular earnings for the shareholder in form of dividends. So if you have a well-run company, at the end of the year, they are going to do what? Do audits and then declare dividends from the profits. And security, however, it rises and falls in accordance with the financial markets and the company's fortunes. So what they are saying is, depending on how your company is being run and how the financial market is going, your equity can go up or down. That's the value of your equity they are talking about. It can go up or down. So that one is what we call equity security. Now, when we talk about debt security differ from equity security in a very important way. Remember, the equity is about your shares, but the debt involves borrowed money and the selling of a security. It involves what? Borrowing money and the selling of a security. They are issued by an individual, company, or government and sold to another party for a certain amount with a promise of repayment plus interest. They include a fixed amount that must be repaid at a specified rate of interest and maturity date. The date when the total amount of security has been paid. So I hope you're understanding what I'm saying. What I mean here is that, one, they are issued by an individual, company, or government. And they do what? They involve what? Borrowed money. So the company can go and borrow. It can also mean what? Diluting your shares, the shares you have, by selling it. So these are the ways you can do what? Raise debt securities. Now, the other one is derivatives. Derivatives. Please bring it back on the screen again. So I know that. So this is what we are dealing with. Just before I continue, you see summarized there. I've talked about equity securities. I've talked about debt securities. Then I'm talking about derivative securities. So please don't forget, equity is about shares. Debt is about loan, the monies you collect, which are distributed as bonds and debentures. I'm going to still talk more about that. Then we are on derivatives. Okay, back to me. Now, derivatives are slightly different from types of security because their value is based on, please note this word, underlying assets. Underlying assets that is then purchased and repaid. So this is the major difference between these derivative securities. They are based on an underlying asset that is purchased and repaid with the price, interest, and maturity date, all specified at the time of what? Initial transaction. So the individual selling the derivative does not need to own the underlying asset outright. So some of you who are doing trading, you will understand what I'm saying. The seller can simply pay the buyer back with enough cash to purchase the underlying asset or offer another derivative that satisfies the debt owed on the first. A derivative can derive its value from commodities such as gas, precious metals, such as gold and silver, currencies, and other underlying assets. Derivatives can also be structured as well as on interest rates, treasury notes, bonds, and stocks. So derivatives are often traded by hedge funds, not mutual funds. So I'm getting into something else. I'm going to talk about that. To offset risks from other investments. So derivatives are mostly traded by hedge funds. So we'll be talking about all this later. Okay, so these are the different types of derivatives. We have talked about securities. We talked about equity securities, debt securities, and derivative securities. Please write these things down. When you go back, you read them through. These are things you must know. They must be flowing inside you like the blood in your veins so that you do not forget. All right. The next thing I want to talk about now is capital market instruments. Capital market instruments. Please pay attention. All these are foundational things that follow investment banking. The language, I'm just teaching you the language of investment banking. Most of you here who are traders already, I'm sure you're going to be hearing this. You're just going there to place, buy or sell. But pay attention. You are going to understand the real fundamentals behind all this. Okay, so what are capital markets? What are capital markets? When we talk about capital market, what do we mean by capital market? So we've talked about securities, put on the screen. We talked about securities. Capital markets is the market for securities. We have debts, we have equity, we have derivatives. So where are you going to see them? Where are you going to use them? Where are they trading? So the capital market is the market for securities, where companies and government can do what? Raise long-term fund. So it is the place where buyers and sellers of securities can enter into transaction to purchase and sell shares, bonds, and debentures. So please pay attention. I have defined for you what securities are: debts, equity, and derivatives. Now, what we're saying is that there has to be a platform. So where are these things used? So that's where it's in the capital market that you use all this. So let's look at the basic capital market instruments. The basic capital market instruments. Look at the screen. Now we have equity securities and we have debt securities. So in equity securities, we have equity shares. And in the other one, we have preference shares. Remember what equity is the share you hold in your company. All of you own companies with CSC. Then in debt securities, we have debentures and bonds. Don't worry, I told you all these terms is for today. I'm going to be spending more time trying to learn what all these things are, so that when we start to flow, it will be easy. But just be right. Any word that is confusing to you, write it down. So when you get home, you try to understand and you let it sink into you. So the basic capital instruments, we have equity securities, we have debt securities. So we have equity shares, preference shares, and on the debt securities, we have debentures and bonds. Okay. Now, when we're talking about equity shares, we are looking at Company Acts of 1965. So this is what we're referring to, that equity shares are that part of the share capital of a company. So this is according to Company Acts of 1965. So equity shares are part of the share capital of what? A company. They are called ordinary shares or common stock. Ordinary shares. These are things you know because all of you are registered companies. So these shareholders are the real owners of the company. Some of you have registered a company with you, your wife, and your children, or you alone. So you are the real owners of the company. So the return on equity shares depends on the performance or profitability of the company. So depending on how you run your company, at the end of the year, that is what the profitability depends on. Okay. Now, what are the advantages of having equity shares? Put it on the screen. Number one is a permanent source of finance for the company. So it's a permanent source of finance for the company. So if your company is doing well, you have enough money to refinance yourself, run the company. You don't need to go to anywhere to look for money. No fixed rates of dividends. So what they mean here is, if in 2003 you made a net profit of 10 million naira, you can declare a dividend of 10 naira per share, 20 naira per share. If by the next year it is lower, that is also how it's going to be for you. Easy liquidity and marketability. So it's easier for you to access fund. It is easier to sell. So what are the limits? What are the limits of equity shares? What are the limits of equity shares? Equity share does not guarantee any return. Like some of you that are looking at me now, your company have never made profits. It's never made any money. So the fact that you go and register a company in the CAC and they say your share capital is 10,000 shares, it does not mean that at the end of the year, you're going to make money. So there is no guarantee. There is also loss of managerial control, because the fact that you're a shareholder does not mean that you must run the company. Okay. Now, let's look at the other. We talked about equity shares. We also have preference shares. So what are preference shares? Now, put it on the screen. Preference shares are known as preferred stock. They are known as preferred stock. So preference shares have two priorities in the repayment of capital and payment of dividends. But the drawback is that when you have a preference share, you don't have a voting right. So we have 4 types of preference share. We have the participating or not participating, redeemable or redeemable or redeemable, or irredeemable, cumulative or non-cumulative, convertible or non-convertible. Okay, so what are the advantages of having a preference share? Remember, you are becoming an investment consultant. Somebody can come and ask you, should I become a shareholder or should I own a preference shares in this company? So what are you going to tell him? Don't think that becoming an investment banker is only going to sell securities. No. Investment advice is key. What should I do? Should I go and buy? So what I'm teaching you now is a knowledge on how you approach that. So from the company's point of view, it's a hybrid security, absence of voting. You don't have voting rights, but there's no dilution of control. And when you have preference shares, you have a fixed return because you will determine this is what I want. Nobody can change it. If you are expecting this amount of money every year, this is not determined whether the company makes a profit or a loss. You have what? A fixed return. You have a fixed return. So what are the limitations on preference shares? What limitations do you have on preference shares? It is not secured. So it's not something that you can use as security, unlike a normal equity shares. It's not really an attractive investment. People doubt what the outcome will be. So, and you do not participate in the management of the company. So all you are looking at more is what your returns are. You do not participate in the management of the company. Okay. Now, let's look at the next one, which is what? Debentures. Debentures. So what are debentures? Please be underlining all these words. As an investment banker, you'll be hearing it every day, every day, every day. So you need to understand what they are. So what are debentures? Now, when a corporation is in need of fund, in addition to its share capital, it borrows money by doing what? Issuing debentures. What I mean is, let's say you already have a company. Now, you have this share capital. This is what you have in the company. But you need additional capital. What do you want to do? You now issue debentures. You don't want to dilute your capital. You just issue. Please put it on the screen. Put it on the screen. So the debenture gets interest, which is fixed at the time of issue. So you as a company, you can now issue debentures and with a fixed interest rate to be paid at a particular time. So please understand what it is. Debentures is you're issuing a document to say, give me this money. I'm going to pay you at a particular time at a particular interest rate. Okay, so let's get to what are the advantages of debentures. What are the advantages? There's no loss of managerial control. It's a flexible source of finance. And it reduces, please put on the screen, it reduces burden of tax of the company. Remember, for those of you who understand taxation, is you do not tax. There are things that you don't tax, like loans, debentures. You don't tax those things. So it reduces your tax burden while you remain liquid to have money to do your business. Now, debentures have their own limitations. Their own limitations. What are the limitations? Can you imagine if Uche Paragon Trading School, I go and issue a debenture, I go and buy maybe 1 million units for 10 million naira, and I'm expected to earn 1 million naira in 6 months. Now, I now hear that Uche Paragon Trading School, after 6 months, have made a staggering profit of 1 billion naira. It will not change what I have agreed my interest will be on that debenture. So it's fixed. The other advantage is that if they also go down, it doesn't concern you. Another limitation, please put it on the screen. Another limitation is that the companies may have to mortgage their assets. So when you are issuing debentures, the people buying your debentures can come up with some crazy conditions. And you are obliged to keep to those conditions. So for some companies, they don't see it as very, very attractive. So I hope you're understanding these terminologies. The next one I want to talk about are bonds. You'll be hearing issue bonds, bond. So what are bonds? So bonds are issued by public authorities, credit institutions, companies, and supranational institutions in the primary markets. So what are they? It's a negotiable certificate that entitles the holder of repayment of the principal sum plus interest. The most common process of issuing bond is through underwriting. So you understand what it is. So when you hear that this company has issued a bond, government has issued a bond, and you buy it. So what they are saying is they give you a certificate. So that means they want to use that bond to raise money. After a specific period of time, they pay you back the interest agreed with the principal. So this is what you call. So we have different kinds of bonds. We have bearer bonds. We have registered bonds, callable bonds, convertible bonds, zero coupon bonds, and fixed rate bonds. Okay, so just to summarize the difference between equity and security, debt security. So we have equity is the owner of the company, debt is the creditor of the company. Then you get dividends from when the company earns sufficient profits, provide steady income to the investor for debt because it's fixed. In equity, you have voting rights. In debt, no voting rights. Equity is not secured. Debt is secured in nature. Share capital of the company is equity security. Borrowed capital of the company is debt security. So these are the differences between debt security and equity security. So capital markets plays an important role in ensuring the emergence of vigorous and an efficient economy. So it facilitates the internalization of an economy by linking it with the rest of the world. So this is where we end this module on securities and capital markets. All right, any question? Any question, please? Anthony, which slide do you want? Which slide didn't you see? Yeah, go ahead. Yes. Okay, Antonia on bonds. Please, can you bring up bonds for Antonia? Go ahead and ask your question. Okay, somebody's asking what is underwriting. We'll come to that. Underwriting is not a big deal. It's just the process of finalizing a transaction, how it is done. Who is there is Pius Amos. I'll give you an example with insurance. If you have your car and you go to an insurance company, maybe you have an insurance broker will come to you, right? He will sell the insurance to you and he will collect your particulars, collect all the documents. Now, there is a department that now processes that your application and generates your insurance certificate for you. That's the underwriting department. So that's the underwriting department. So let me use insurance to illustrate that for you. Okay. All right. So before we go on break, few minutes break, I want us to talk about a common term. I'm going to be showing you 2 slides on that. Convergence of buy side and sell side. All the traders here already, you already know what it is, but let me talk about it from another perspective. Let's talk about the convergence of buy side and sell side. This is the next course. Please, these are some of the things that you need to know. Okay, so when we talk about buy side and sell side, this is the basis of trades are positions you take as a trader. So let's define it. Let's define a buy side and sell side. So put it on the screen. A firm that invests in securities for clients and possibly on its own is called a buy side. A firm that invests what? In securities and possibly on its own is what? Called what? A buy side. Please, I don't want you to look at it from your normal online trading perspective. So don't look at it from that angle. It's still the same, but I want you to look at it now as an investment banker. So a firm that invests in securities for its clients, you know what securities are now. I've taken time to define it. It's on the buy side. Then a firm that receives the orders from its clients and forwards them to execution is called a sell side or a broker. So sell side activities can involve brokering, dealing, advisory services, and investment research. Okay, now look at the screen. So this is what we have as a buy side, and this is what we have as sell side. So people on the sell side are asset management companies, hedge and mutual funds, institutional investors, and retail investing. And on the sell side, we have investment banking, brokerage, and prime brokerage. Don't worry, I'm going to, by the end of today, this will be very, very clear because I'm going to be using this to finally get into the practical side of everything we are doing today. Okay. Yes. No, later I'll get back to that. I don't want to get, okay. So now, please, I'll just leave your questions. I will answer them. I'll answer them so that we don't break the class. I'll ask, just leave your questions on the chat. I will answer all of them. So for the sake, so go to, you have an account that runs this. Please put it on the screen. So we have a discretionary and non-discretionary account. So we talk about discretionary account. It's an account that allows the portfolio manager to manage the account and buy and sell securities without the client's consent. So what we are saying is that I'm sure that some of you, you just give money to a portfolio manager or an asset management company, or some of you are doing trading, you just give money for somebody to trade for you. So he can do whatever he likes without your consent. So that's discretionary. Then non-discretionary is when you have an input as a client. You need to provide information on how that transaction is made. You need to provide information on how that transaction is made. Okay, so let me have the next screen. Okay. Okay, now when we talk about, let's see the workflow of the buy side. So the buy side usually trade with multiple brokers for multiple markets. So they can also trade with multiple brokers for the same market. So you can see the workflow there. So the buy side can actually trade with multiple brokers for the same market. They can also trade for multiple markets. They can also trade with multiple brokers for one market. Okay, go to slide 8. So look at the flow for the sell side. Look at the flow for the sell side. So the sell sides are electronically connected to exchanges they cover. They offer their clients various channels such as online, DMA, via fixed routing networks. Brokers are focused on the market they cover only. They do not worry about the exchanges and data. Okay, please don't get confused about some of these things. As we progress, I just wanted to define some of the terms so that it will be easy for you to understand. As we proceed, okay. I'm noting your questions, so I'll definitely attend to it. Okay, now look at the screen again. Please get the other slide, buy side 1. I want to explain this properly for you. Put it on the screen. Put it on the screen for them. Okay, so remember what I was explaining. Okay, now it's on the screen. So we have the buy side and the sell side. So go to slide 3. This is how the organization looks like. So go to the next slide. Now pay attention here. So on the sell side, you are having the company, you have the industry and economy. So what you are doing on the sell side, as an investment banker is you are going out there looking for opportunities, recommendations, analysis. You are finding some of these things out Now, when you now get it, you will now go to a buy side, maybe as an asset management company or an investment bank or whatever, portfolio manager or hedge fund manager, and say, look, I have seen this business. I have done the analysis. Please look at it. Then the people on the buy side will not pick it up from there. So you see how it works. So this is the flow, how it goes from the sell side and to the buy side. So the sell side is like the research people who go out there to analyze and find businesses and now push it to the buy side. So now, in the investment, when you talk about on the buy side, on the sell side, there are mainly people on research. It's not like the way you understand it. It's people who are selling, and when we get to the next module now, you'll understand this well. People who are selling are actually research people who explore and find out opportunities, which is pushed over to the buy side. So go to slide 7 now. So what do you do on your sell side? You produce and sell research. That is what you do. You produce and sell research. So those of you here who are into IT, this is where you can fall in. We're going to be doing equity research immediately after now so that you understand what I'm saying. So under equity research, this is your job. You need to go there. You look at Nigeria breweries. You look at Coca-Cola company. You do a research. I'm going to show you an example of what an equity research looks like. So this is what you begin to sell. This is what you now sell to companies that they buy. It's not just like taking a sell position or buy position. No. This is what you sell as an investment banker. Okay, so I'm going to come back to this. A lot of operative words are popping up. So I think I will go back to teach you equity research. So when I do equity research, you will understand how this process flow goes from the buy side to the sell side, which is very, very important. So any questions? I'm going to come back to that. I just wanted to introduce that for you a little bit. Then we'll go to that. So let me, if you have any questions, you can ask before we go to equity research now. Any questions so far? Okay, please, I need you to pay attention. I know a lot of you are wondering, what should I be doing as an investment banker? What is my work? Don't worry. At the end of the day, you will definitely find something to do. You don't need to go and work in the bank and wear suit every morning as an investment banker. But I'm breaking everything down so that you can grasp something to say, this is my interest. I want to begin to develop on this. And for some of you, I will also try to help you. If you want to begin to sell some securities, you want to do some, we are there to assist you. But that at the end of the program, I'm going to introduce that. Okay, so let's get to equity research. Please, this is very, very important for you as an investment banker. Put it on the screen. Understanding equity research. Understanding equity research. So now I just talked about buy side and sell side. Buy side and sell side. This equity research is the tool used by the sell side. The sell side have to find out where the opportunity is. And how do they do that? It's through equity research. They have to go out there and do a lot of research and put it out there for people on the buy side to take and execute. Okay, so what is equity research? You must, if you are an investment banker, this is a very important thing you must know. So what is equity research? Put it on the screen. It's an investment advisory service. So that's what it is. You are advising. Equity research is a study of equities of stocks for the purpose of investment. So this is what it is. It's simply what? An advisory service. And it belongs to the sell side. It belongs to the sell side. I'm trying to let you, I just introduced it so that when I start talking about it here, you will not be confused. So equity research is for the sell side. So it's an advisory service. So what do? You study equities, you study stocks, what they look like. So this is what you give to all these fund managers, mutual fund managers, hedge fund managers, who will do what? Invest it. So the purpose of equity analysis is to study companies. You study companies. You analyze their financials. Look at quantitative and qualitative aspects for decision, whether to invest or not. Remember, people are pulling in money, giving in money to an investment bank. They're looking for where to put the money. You cannot just go and say, Paragon Trading School is go and put money there. No, you don't do that. So that is the mistake some of you make in trading. When you go to trade, you just place a trade. You don't do what this equity analysis. It's very, very wrong. Trading is not trial luck. It's not luck. It is not robots. It has principle. You have to trade like a trained investment banker. So all these people that go, they place trade, they buy this, they are using pattern. That is rubbish. It is nonsense. So you must do equity research, is to study the companies, analyze their financials, look for it properly before you do what? You decide what to do. You don't go to an investment bank and they collect your money. You put in 5 million naira into an investment. I'm going to be teaching you practically. That's what I do, part of what I do for a living. So for some of you who are interested, I'm going to teach you and put you under my downline. So when you put in that money, you don't just go and start placing. All this, and some of you, somebody was asking me here what you're supposed to be. You don't need to go and become an investment banker. You can just become an analyst, equity research analyst, providing all this information. So what is the process? What is the process of equity research? So equity research comprises of these following steps: economic analysis, industry analysis, company analysis, financial statement analysis, financial evaluation modeling, report writing and presentation, and what? Recommendation. See, you can see the steps involved before you place a trade. You don't just go there, they tell you, put buy and go and say, no, 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 no. It's not something you do just like that. There is an investment analyst, an investment banker, like some of these my friends here who are into IT. You can take up this one. This is your job. You do all this and people buy it for a lot of money. So you can see the steps: your economic analysis, industrial analysis, company analysis, financial analysis, valuation modeling, you report. I'm going to give you an example of what it looks like. So this is already one aspect some of you can pick up. Being an investment banker does not mean you should be running around taking money from people and investing. So what are the applications Number one is investment evaluation, mutual fund industry, for mergers and acquisition deals, financial publications, and charity endowment. So all these require equity research. Okay. Now, what are the skills required? So which one of you listening to me and get into this one? Number one, you must have excellent financial analysis and equity research skills. You must have that. Global and business analysis knowledge. You must know how to make presentations and have writing capabilities. And you must know how to make good judgment. Good traders retain equity research fellows. If anybody that is trading for you that does not have equity research people, run away from that person, except the person himself knows how to do it. If not, is you doing guesswork. He does not understand what he's doing. He must understand how this is done before he will say, I'm placing a trade, I'm buying a security, I'm doing this investment. What is your basis? Okay. Now, what are the benefits of equity research? Number one is improved liquidity. So consistent research with detailed initiation reports and quarterly updates increases liquidity and helps company to trade at fair prices. So you can see that when you can get more money when you have good leads. If you're able to have good leads, which you promote, it will bring money, easy access to capital, enhanced visibility, and easy management bandwidth. So you see, what I mean by this is too much clogged up activities in top management, taking decisions. So these inputs are already coming done. It's just like somebody finished cooking food and putting it on your table to eat. So that's how it works. Okay. Now, the job nature of equity research analyst. For those of you who want to get into this, so how do you go about it? Put it on the screen. How do you go about this? Number one, you need to gather and analyze data from different sources, company documents, SEC, regulatory materials, provide primary analytical support for analysts, perform financial and valuation analysis, and generate financial models, work closely with primary and secondary market teams worldwide to ensure the maximum benefit of their daily analysis for your clients. Go next page, next one. Writing company and industry reports. I know some companies paper under coverage, write research reports, build on maintaining earnings of cash flow, recommend investment strategies. It's a huge thing. This is one of the best professions you can have as an investment banker. Interact with institutional and retail sales people, conduct intensive company and what? Industry research. Okay, monitor company news and events. So it's a lot. You know, I remember the Uche those days, he would tell me, go and read Bloomberg, go on to this market, this. So what he's doing is equity research analysis. This is how you know a good trader. A good trader is not an intelligent man. It's not somebody that is sharp. It is somebody who knows how to do equity research. So that way, he is not doing any guesswork. Anything he does in terms of investment has more than 70% of success. Okay. Now, remember, I've been talking about the sell side and the buy side. So how do you make money from the sell side? Now, look at the screen. How do you make money from the sell side? You see, I have spent time talking about this. I've spent time talking about this analyst. I've spent time talking about the analyst. So this is how it works. So there is an information on a housing project. There's an information on a housing project. Now, the analyst, which is one of you, you go and research and get the information. You see how it works? Now, it feels that this is going to be a very big opportunity for Home Depot and Lucy Company. Now, the information is given to the sales deck during the morning call. So he gives the analyst, after you have discovered, oh, in Gulf Estate, they are having this one in Lekki or in Lagos, there is this blah, blah, blah. Then he gives the information to the sales deck. Now, the sales deck will now call the buy side with the analyst in recommendation. So on the buy side is the portfolio manager. Look, that's a deal. Remember, these people on the buy side, they already have money looking for what to invest. I want you to understand how this thing works. The people on the buy side, they have money. They are looking for where to invest. So you on the sell side, this analyst group, it is your job to convince them, look, come and take this deal. It's going to work. It is going to work. Okay, next screen. Now, the portfolio manager discusses with the sales person. Is interested in getting exposure to the group, then he cannot decide, then he calls the analyst. Now, the analyst provides more information. We received an information from the sales desk. The portfolio manager is now talking to the analyst. We need more information on it. Now, go to the next one. Now, based on the analyst's feedback, the portfolio manager decides to buy. You see how it goes? The analyst is doing the work on the sell side. He's gotten this lead. He calls the sales deck. The sales deck calls the portfolio manager or who has all the money to invest. The portfolio manager calls back the analyst, explain more what you gave to the sales deck. What are you doing? Blah, blah, blah. Then they place order for 100,000 shares. They'll tell the trader to buy the stock and sell. So you see how it works. It is not try and lock. It is not robots. This is how it works. Now, go to the next screen. Then the buyer side calls the sell side traders and places the order. You see, it now places the order. Then find the seller of 500,000 shares at $50. Then takes the shares to buy the sell side for 50.04. So you can see what it means. Now, the sell is now placing a sell. So you don't just go there and because you like, they show you one trend, one candle trend, or this. Because of that, no, not an investment. You must get an analytical report of what you want to invest. So I'm giving you one good job opportunity now. So these equity analysts are hot. They are very, 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 very hot in the investment banking industry. So you can see the flow. Now it's time to place the trade. Now you can see it. Now the commission, remember they've added $0.04. Now look at it. Now the commission of $20,000 on the trade is split among the three areas which contributed to the trade: research, sales, and what? Trading. So this is how it works. This is how it works. So I've given you a very good view about how trade is placed, how it is done. So it starts from the equity research analyst. He calls the desk calls the portfolio manager. He comes back to the analyst. He goes back and forth. They place the trade. Of course, it's going to yield profit and money is shared accordingly. Okay. For those of you who want to become analysts, so this is how you start. You have the trainee, put it on the screen, the trainee, equity analyst, senior analyst, assistant manager, managing director, the CFO, the CEO. So you can rise like this. You can work in a company or you can work on your own. But I advise that you get some experience. So the research team is usually made up of 2 to 5 people. You can come together and set up this kind of activity. All right, so that is the equity research. So you actually now understand when we talk about the sell side, you know what it means. You understand fully what the sell side is, and you understand fully what the buy side is. Okay, so what I'm going to do now is to show you an equity research example, just what it looks like. I want to show you a report. I want to show you a report. Equity research report. So let me give you an idea of what the report looks like. Okay. Now look at the screen. This report is for Suzuki. You people know Suzuki. That's a motor company called Suzuki. So this is what some of you be doing this. It's just like writing a feasibility study. Now look at what it is, introduction about the company, and there's some analysis. Some of you know what this is already. SWOT, GAIC, industry, blah, 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 pestle. Okay, so let's just go through it. So please just go to slide 5. So this is about the company that they are presenting the report on. You remember Suzuki. So I'll just be going through the slides. I want to show you what the report looks like. So these are the key people, like those of you who will be writing the report. A little bit about the company. Now, go to the next. This is slide 7, analysis. Okay, this is industry analysis. Industry analysis. So, you remember, please pay attention. Why, part of the reasons why we need equity analysis is, if I tell Ugo Paragon Trading to present an equity report, he's going to hype it. So that's why this report needs to come from an independent person. Now, put it on the screen. You see what the remark they are making here? It says this company is overvalued. Why? Because it's already on maturity stage. You see, when a company is getting to maturity, look at that graph, it is dropping. It's no longer growing. It's getting into decline. So the valuation is wrong. Now, look at the next one. That's the pestle analysis. You know what pestle is? You are looking at the political issues, economic issues, social issues, technological issues, legal issues, and environmental issues. So these are some of the things the analyst would look at. The next one is the BCG matrix. This BCG matrix for the industry. So where do they fall in relative to other kinds of activities that are related to them, manufacturing, defense, all other companies that are related to them. Where do they fall in? So now go to the next screen. So this is where it is analyzed for them. Invest or hold, invest to grow, danger zone harvest, all those things you need to learn. So what they're analyzing is the business strength against the industry attractiveness. Don't worry about this. For those of you who become investment analysts, you're going to equity analysts, you're going to learn all this. Some of you know all these tools already. Like the next one now, some of you know it. The SWOT analysis, you already know it. So all you need to learn is some of the tools that you don't know before. Some of the things that are here, you know it. So all these are, go to the next one, 45 forces control. So these are some of the tools. I'm just showing you what an equity analysis look like. Product life cycle. Now, company valuation. So you can see how they value the company, the enterprise value, and the equity value. So this is where people on the buy side now begin to look at. This is where they begin to pay attention. This is where they begin to pay attention. Now go to the next one, the book value and the comparative measure. So this is where the people on the buy side, you can see, you don't make investments for nothing. This is why you cannot understand why investments are not working in Nigeria. How many of them go through all this? They don't. So now look at what they recommended. Look at the recommended. Sell your stock. So low return on equity is 7.58%. Company is almost what? Debt free. So these are the suggestions. So this could be very, very attractive to people on the buy side. So the portfolio manager can now decide to go and do what? Buy this stock or security for their clients. All right. So any questions? So I've given you, we've gone through equity research, and I have shown you how you do the sell side and the buy side. The sell side and the buy side. All right. Any questions? We need to go on 10 minutes break. Okay. Short break. Yeah, thank you. First time. Don't worry, you people are on to become after the next class, when we come back, you'll be very, very happy because you know that you didn't waste time coming here. You must go back with, I will give you a tool, something to do. And for some of you who are ready to make money, you can start making money from tomorrow. Does it sound strange to you? It's going to happen. So see you after the break. Thank you. How are you guys enjoying? I hope we are gradually developing some investment bankers now, some analysts, mutual funds, promoters, hedge funds, professionals. I hope we are keen in. All right, just for a recap, we started in the morning. We've defined what investment banking is. I told you the difference between a commercial bank and an investment bank. And I've explained to you what an investment bank stands for and what is the work of an investment banker. I also tried to explain to you some of the terminologies you will be speaking. Like every profession has its own language. law, medicine. So investment finance has its own language. So we talk about securities. So we talk about securities, you're not confused to understand what securities are. Debt, equity, securities and derivatives. Talk about debentures, all that. We talk about bonds, all that. We mentioned all that. I tried to explain to you. I tried to explain to you what capital market means. A place where you trade all these securities. I also tried to explain to you what we mean by the left side and the buy side and the seller side. And I also explained to you how an investment flows from the left side to the seller side to the buyer side. The work of an analyst who sees an opportunity, analyzes it, sets it up for somebody on the buy side, could be an investment bank, could be a portfolio manager, who could also be a hedge fund manager, which people have already contributed money, and the investment analyst will help you find a particular trade. And I warned you that trading, contrary to what they told you, is not by what do you call that again? Robot. It is not by juju. Some of you go to make medicine to trade. It doesn't work. I've taught you today that you need to do analysis. When you do proper analysis and you place a trade, it is not possible that that trade will go bad. All right. Now, I want to get a little bit more practical. This is our last course for today. And after this course, I'll be introducing you to some of the things you can be doing. Then next week, we will take up some real investment papers. What are the things you can be doing at your stage? Not all of you can get a job at an investment bank, but right now you can actually stay on your own and begin to sell investments. So next week, we'll be doing more. We're still going to talk about technology. There are a lot of things I've not talked about, mergers and acquisitions. There are a lot of other things I've not discussed. We discussed that, but solely we will get into talking about some of the investment products you can sell without working in the bank, in the investment bank, or in a company. You can just be a financial advisor and you'll be selling these products and you make money. All right. So what we're going to be talking about now is about asset management companies. Asset management companies. Asset management companies. So what is an asset management company? What is an asset management company? Please pay attention. Now, look at how investment works. Assuming Uche Paragon now is a fund manager. So you give him money. He collects money, pool of funds, collects pool of funds from clients. And what is he trying to do? He's looking for where to invest that money so that you can make profit. He's already told you that, look, the investment that you are putting will guarantee you 20% per annum. This investment you're putting will guarantee you 30% per annum. So Uche Paragon Trading will now be looking for where to invest these assets. These assets could get into stocks, it could get into bonds, it could get into real estate, and more. So this is what an asset management company is. Put on the screen. So an asset management company employs professionals to conduct research and make investment decisions, to manage these funds, like mutual funds and investment funds. So I'm sure you've been hearing about JP Morgan's, you've been hearing about BlackRock, Vanguard, all those things. These are top investment companies. So, but in Nigeria here too, we have some of them like Cowrie Assets. I will mention my own last. I'll use my own to end. We are the best. I use my own to end. We are the best. So, but you've been hearing about all these investment companies, asset management companies. So I really want you to pay attention to this, because at your level, this is where you can quickly key into. And after this class, you can begin to practice immediately. Okay, so what are the activities of asset management companies? What are their activities? Put on the screen. Number one, they enroll investors into mutual funds and other investment products. So an asset management company is going to enroll investors into mutual funds and other investment products, advising potential clients in the range of investments and choices available, distribute mutual funds information to a client, and recommend the best investments for the clients. Provide statements of accounts, annual reports, performance information, may manage investment accounts on behalf of customers, may participate in funding various investments on behalf of investors. Self-source administrators, various types of retirement accounts, units, and investment trusts and other investment products, may operate a hedge fund for a private partnership of investors, may also operate a private equity fund to invest in companies, arrange mergers, buyouts in other investments, corporations, including what? Startups funding. Okay, so now pay attention. So what I've been explaining is the same as what I mentioned. So many of you listening to me will become portfolio managers. Your link, immediate link, will be with an asset management company. So you may not really work with them, but now that you're going through this training, by next week, when I teach you some investment products, let's say the money market fund, it is easy for you to approach somebody and explain how the money market fund works. And you get the investment and you give it to an asset management company. Then the asset management company can pay you a commission. But the truth is that you understand what money market fund is, you understand what equity fund is, you understand what a treasury bill is, you understand what a dollar bond is. We'll be talking about all this next week. So now you may not be directly be part of this asset management company. I'm going to be telling you how you can get involved with them. All right, so what are the functions of an asset management company? Financial intermediation, management of investor accounts, funding various investments on behalf of investors, designing various investment products and retirement plans, managing hedge funds, and operating private equity for mergers, acquisitions, and buyouts. So you've been hearing about all these asset management companies. So this is actually where you can key in very, very easily. Okay, there are certain roles which asset management funds play in business. They play a lot of roles in business. So they require an infrastructure which will include the following. So what is here, please pay attention now. This is actually what you can do. Some of you will be wondering, why am I in this class? What can I do? So look at it now. Number one, they need a fund manager to manage the assets of the mutual fund. Again, we've talked about analysts. They need analysts. So this is what you can do to research equities and fixed income investment. We spent a whole course talking about equity analysts. They need economists to evaluate the direction of the market and the economy. They need salespeople and marketers to persuade people to buy the fund. So this is what I'm talking about. So you can start with that almost immediately. You can start with that, just like you have real estate, people selling real estate. So immediately you can begin to sell investment, and you're lucky your facilitator is one. So you just get onto my downline I tell you what to do. You find investors and you are ready to make money. You need traders to execute the orders. You need accountants to track the assets. And you need tech specialists and back office staff. Okay. Now, how do asset management business companies work? How do they work? How do they work? Asset management business companies. Put it on the screen. So number one, asset management is in the business of using money to make more money. So that's it. So asset management companies manage the money of their clients to achieve specific financial objectives within the guidelines on which an investment is organized. The pool may take in form of a mutual fund, hedge fund, retirement, pension fund, and other institutional funds, depending on how the fund is organized. So asset managers could invest in any range of investment vehicles, including equities, fixed income securities, and derivative products such as options and futures. Some of these terms I will explain more next week. Okay. Now let's look at what you could be immediately. What can you become immediately in an asset management company? Number one is a financial advisor. A financial advisor. So please take these things down because a lot of you have been asking me, how do they start? This is your immediate kick-in. So an advisor's primary role is to acquire new clients, sell them a variety of products from the stock recommendations and mutual funds to annuity-based life insurance. So this is your role now, which I'm going to be offering you next week when we are done. I'm going to give you an opportunity to become a financial advisor and allow you to see how you can sell these products. We're going to be discussing with Uche. We can be having some more trainings that will also improve your knowledge. Now you have institutional relationship manager. It ensures that institutional clients of mutual funds or institutions are happy. So these are at a higher level. You know what I call institution clients, you know, heavy ones like government people, big corporations and all that. Then you also have institutional sales manager. Then you have private bankers. So these are some of the roles that you can play. So what makes asset management companies different? They have a larger pool of resources than individual investors. So what the difference is this: when you are working as an investor, you are a solo portfolio manager, you may not have enough money, enough resources like an asset management company because they have quite a lot of money to invest. So that is major, what makes them different. These asset management companies, they are huge. I told you I'll be talking about my own at the end today. So now we're talking about these funds, these funds. How are these funds allocated? So we have put it on the screen. We have basically three types of funds. We have three types of funds. We have the mutual funds, we have the hedge funds, and we have the pension funds. There are other ones. Probably I'm going to be talking about financial markets next week. So I will also explain more of these funds to you. Now you have three funds: mutual funds and hedge funds. So mutual funds is an investment vehicle that is made up of a pool of funds collected from many investors. So you collect money from a pool of investors for the purpose of investing as stock, bonds, money market instruments, and other things. Some of you who have been duped before, some people, somebody tells you invest 1 million naira, 2 million naira, I'm going to give you a return of 30%. Actually, that's supposed to be a mutual fund because many people are contributing to it. But you see, from the knowledge you are getting now, you could see that the man that is collecting this money from you does not know the process of how mutual funds are managed. From what you have learned today, you will see that these people do not understand the ABC about how mutual funds are managed. So, mutual funds are operated by money managers who invest the fund's capital and attempt to produce gains for you. So, a mutual funds portfolio is structured and maintained to match the investment. So, you understand what it is now. So, a mutual fund is, so when you go to maybe some banks now have all these mutual funds, which is what we're going to be discussing next week. I'm going to mention some of them before we close today. But next week, we'll be looking at them as they have different names. They call it different names. But we'll be looking at them as products. But I want you to understand it's a pool of funds collected by an investment company, an asset management company. Then on their own, they will now look for places to invest them. Now, talking about the hedge funds. The hedge funds are also like, they also put funds that you put together under different stages to earn return for their investors. Now, but hedge funds, unlike mutual funds, are aggressively managed because they make use of derivatives. Not the difference. Mutual funds don't use derivatives. Hedge funds make use of derivatives and leverage in both domestic and international markets with the goal of generating what? High returns. So hedge fund managers manage more of the derivatives. So those of you who are traders, like Paragon is a hedge fund manager, or he manages hedge funds because he deals with derivatives. He deals with derivatives. So in derivatives, you are dealing with the what? Underlying assets, not the real assets. So you understand how it works. Then pension plan is just like a retirement plan. It's usually tax exempt. So these are some of the plans where an asset manager can work. That's how an asset manager can work. Okay, so this is where I want to leave it for today. But before I close, I told you I'm going to make a proper introduction for myself before I close the class. Now, I am connected to, look at the screen, AXA Investment. I'm sure most of you know AXA as HMO. Yes, we're HMO, but we have an investment arm with the biggest assets under investment of over 800 billion euros. So it's about the biggest in the world. It's about the biggest in the world. So if you go to my page, you will see adverts like this. You see adverts like this. This is me. Where am I? So most of you who will engage, I'm going to pull you into this business. So you begin to sell some of this investment. This is money market fund. It's a mutual fund, just like I mentioned. So it's a mutual fund. So I am now like a financial advisor. I go and convince people, make presentations, advise them to invest wisely. Take, for instance, people will go and put their fixed deposit at 3%, 5%. As at last week, money market fund is 18%. They don't know these things. So you need to understand how it works. So when you now convince this client, you now take it to your asset management company. The asset management company will open an account for you and you begin to make money. They pay you a percentage based on the investment assets you are putting. So next week, we're going to be talking more about some of these investment products. So some of them, please look at the screen. These are some of the investment products we'll be looking at: money market fund, equity income fund, dollar bond fund, euro bond fund, treasury bills, commercial papers, and then third-party fixed deposits. So all this we'll be talking about next week. So that's where we'll end the training for today. I hope you enjoyed the class. All right. So if you have questions, please, I'm going to tell Google Paragon to create some form of interaction space where I can talk to you guys. But my goal is, after this training, all of you will have something to do with investment banking. God bless you and thank you. If they have something to say, bring them back in. Don't go away. All right, so let's see if you have anything. Antonia, thank you so much. Very enlightening. Thanks for that. We enjoyed it. This is great. Ah, that's good. That's good. That's good. Good feedbacks. Okay, Ugo Paragon, do you have anything to say before we close for today? Do you have anything to say before we sign up? Please, we need like a WhatsApp group. I need a WhatsApp group with these guys. I want to engage them and move them into the market. So whatever they are, they can begin to make money. After next week, I'm going to teach you practical offerings on mutual funds so that you begin to make money and be like Ugo Paragon, my friend. All right, you can talk now.
So yeah, thank you. Basically, we're not closing now. Your section is just coming to an end. We're moving more into practical. We don't have a WhatsApp because of policy and data prevention issues. Like, we want to protect everybody's data, but we have a channels where we can communicate. And again, we will send your data across to them and also send their data across to you for any of them that want to like diversify their portfolio to that aspect. Yeah, so issue of WhatsApp group, it will make people start fishing on each other. So we don't want that. We want to protect everybody's data. So that's it. But I think the class is very much insightful. Of course, it was beyond our expectation. And I could see a lot of feedback is coming in. Many people are talking about. It's very insightful, everything. This is what make us different, what made us to be one of the best trading company in, let's say, in Africa now, or let me start from Nigeria. Because we are not just doing a guesswork. We know what we're doing and how we have experienced team that surround us. So it's like, until you come closer to us, you will know how powerful we are and the kind of capacity we are building. But I think you're actually in a safe place, learning and trading with us. So by next week, as you have said, we'll continue from there. Remember, there's a lot to learn. There's a lot to learn, a lot to learn. When we are finished cooking you on these things, you'll be able to develop a proper investment strategy and see the opportunity of making that amount of money which we set up as our target. Many people will make that amount of money. Yeah, it's also in line with what I used to tell you during our practical class, that our goal is to help you identify potential opportunities and you act on them. It's not just by trading, doing what you don't know about. Potential opportunities in various markets. Once you identify them, we'll call you in and explain it to you, analyze it with you, then we execute. And then we'll now see the result. That's also why, since 3 weeks now, you see that most of our analysis and trade we are all close on profit. By 4 p.m. now, we are going into oil and gas. Today is oil and gas trading day. We'll see how we can be able to navigate. Remember on Tuesday class, when we did something on gold futures and spot. So we're still calling on people who want to trade spot with us instead of derivative alone. to start getting on board so that we can be able to start navigating into the market. Thank you so much, Dr. Emeka Onachukwu. It's a wonderful time and a wonderful lecture. So we are navigating back to practical, because a lot of them are trading already. We navigate back to practical. So let me know if there's any feedback before I reclaim the host. Shall we go back to practical, or do you want to ask Mr. Dr. Onachukwu more questions? Is there anything you want to contribute to the lectures? You can unmute yourself and just say, let's just say in 3 minutes time, in 3 minutes, exactly 13:15, then I will reclaim the host. Do you have to say anything verbally? Is there anyone out to say something or contribute anything? Is anyone?
Okay, sir. Okay, sir. Good morning. Good day, sir.
Yeah.
Okay, sir. I want to know, because I'm trying if I can go through the work again, like today's program on investment banking, something like the slides. If we can, I'm asking if there's a way we can have access to it again, something like that, so we can go through it.
Okay, no problem. It's possible, and we're also going to make the video available on our channel, so you can also watch it over and over again. I will ask for the slide, whether it's gonna release it now or whether it will release it at the end of the program, because
Okay,
we didn't finish everything today because of time factor. Is there anyone that want to say something or contribute anything? If you didn't talk to me, I will assume that you just connected to the Zoom and probably you're busy doing something else. Okay, that's fine. I'm not getting any other feedback from you. So thank you so much, Dr. Onachukwu. I'm declaiming the host now. We are switching over to practical. Okay. We did analysis on Tuesday on gold. Anna Colinda, you traded. Did you gain that market?
Yes, sir, I did.
Is it still gaining?
Yes.
Is it still gaining,
No,
or you have closed
I've
it?
closed it. I've closed it.
Because of your mind. Miss Antonia, you traded as well. I think not on gold, on I think Euro and Australia. How far with them?
Okay, yeah, I did. The AUD, it gained, but not as I expected. Well, it gained. Then the USD, we are still on it.
It gained as we expected, but the value you gain in dollar may be what you mean by not as expected.
Yeah,
I understand. Why I did it that way is one thing. Consciously, I reduced your trading volume to 0.03 or 0.02. So yeah, because we're trying to build your mind towards trading, and also try to make sure that we follow our risk. So we need to start trading specifically following the trading plan. We need to know how much you'll be gaining per each trade. Do you understand? So now your risk management now will be what we'll be using to trade. It will determine how much you'll be gaining per each analysis. Do you understand? For example, assuming we increase your risk, maybe let's say 30% maximum. Then you could make the first week with 10% or 15%. Okay, let's say 10%. Yeah. Then that 10% now could be giving you much bigger volume, like in terms of dollar value of your trade.
Yeah.
Then if you have a opportunity like what happened in Australia, at least you could be making about $100 or $80 or $200.
Yeah, that would
Then
be
if you still
better.
then if you want to make more, but it's all based on your risk tolerance, what you can tolerate. Once we understand it, then we'll not be able to strike. One, as you have seen from this lecture on investment banking, see that there are different types of investment, different types of market and motive. So me personally, I'm a medium and high risk taker. That's why I don't invest in mutual fund and treasury bill. Do you understand? Then why even stock, I don't like invest strongly on stock, but stock this year is attractive anyway. It's making me not try to invest on foreign stock. Most foreign stock has gone over like 30-something% this year. Now, if we're able to know those, you are risk tolerant now, we can be able to increase your risk, like trying to increase the volume of your account. But if your understanding about this derivative market is relative to fixed income market, we have to make sure that it's shifted back to derivative so that you can be able to maximize the potentials. How you make profit in this business is by level of your risk. That's also how you make losses. So if risk is a little bit low, if risk is extremely low, return will be extremely low. If risk is medium, return will be medium. If risk is high, then the return will be high. Do you understand?
Yes.
So once I'm okay with your risk, then we can be able to start striking bigger market. Who else traded? Not everybody is here today. That's a familiar name.
Can I answer
Okay,
to that?
Sorry?
Hello.
Yeah,
Can I
I can
answer
hear
to
you.
that now, or that should be later?
If I answer now, you can answer. If you want to be personal,
No,
we have a personal class.
for the risk. I know I
Okay.
mentioned it before, maybe you forgot. I'm more of a medium to high risk person. I want to be, that's why I fall in. Because
Okay.
I have so much trust in your experience and everything. So I feel if I'm to go and maybe take a trade, we have the percentage of gaining on that trade is high. So of course, I'm comfortable being a medium to high risk.
Yeah,
While
okay.
still
So there was a trading plan we shared before. There was a time we had a meeting, and we shared a trading plan of is it $1,000 trading plan
have
that
the
time?
1,000. Yeah.
Okay, you have it. Yeah.
1,000.
I think that plan is drafted on medium risk. So I will try to get it on my laptop to see.
That's on 10,000.
Sorry.
It's on 10,000. I think I checked that. The plan was on 10,000.
I
No,
have
we still
one.
have the one of 1,000.
He gave me the one of 1,000.
Okay, you can share.
Yes, I'm searching for it on my laptop now to see if I can see it again and share it. And then there's a volume that we describe on that place. Volume we'll be using to trade. So that volume now we'll be able to. That's what we'll be using to fix the
On 1,000 is 0.03.
0. But that thing is on commodity. This thing instrument that we drafted it. So that 0.03 on currency now will be 0.3.
Okay, it will be 0.3. Okay.
Yes, it will be 0.3 because 0.03 will give you 3 cents, which will run
Yes.
forever, which will run forever for you to make profit. Yeah.
Yeah.
So it will be on currency, we will make it 0.3 because currency is giving one pip $1. While in commodity, give 1 pip $10, like on one lot size. So on 0.03 will give you 3 cents. Then 0.3 will give you 30 cents.
Okay.
Do you understand? Yeah. So that 30 cents will be, I can't find it. Okay, I find it now. Let me share it.
Okay, so you use the cents to multiply the number of movements, the peak, to determine what to make. So you can determine your profit even before entering a trade.
Yeah, sure. We have to be even our risk. We have to determine it. Do you understand? Somebody was even our risk, how much, if let's say we are trading now, assuming this thing lose, how far, we can determine it by ourselves.
Okay.
So kind of it makes us not to be emotional about trading because we already know. So we're not in a guesswork. Then if that risk is too much, we will not go in.
Okay.
Do you understand?
Yes.
Yeah. For me, that's how I trade. That's why my emotion is not too high because I'm already known like, okay, assume if this thing now, what if this year Australian US for what will happen? You know what I mean? I ask the question. I know how much capital I'm trying to trade and my equity. So if the risk is too much, I will reduce it immediately. Immediately, I will reduce it. If it's something that is okay, that's within my plan, I will allow it. So when I'm having a loss, I also check whether the loss is within our risk measure. If it's within our risk measure and it has not hit stop loss, I will leave it for some time because, like now, it's giving market chance, giving myself more opportunity to know whether it will rebound. Once it rebound, fine. I will now continue trading. Now, you can see my stream now, right?
Yes.
Yeah, you see on the expected volume, this 0.03. This 0.03 should be 0.3 on currency.
Okay.
Yes.
Okay.
So it will give you 30 cents per movement.
Okay.
So on that 30 cents, 10 pips should be giving you approximately $3.
Okay.
Do you understand? Yeah, about 10 pips will give you approximately $3. So we may adjust the PIP target because these are monthly. So this PIP target is not that anytime we place it, it must go on 500 pips. This PIP target is cumulatively in a month. If we're able to get 500 pips in the market, then we can be able to make $150 profit. Now, sometimes we can make this PIP target maybe in a week. Market can get 200 pips in a week. In a day, it can go up to 100 pips or 200 as well. So it's not that each trade will target 500. We could be targeting it based on the market of the week. We could be targeting at 150 or 200. Then we'll go out of the market. But in a month, it may be up to 500. Then if we are using 0.3 by each trade, the maximum trade should be 0.6.
Okay. In total.
Yeah, so that, yes. So if you have two, two positions, 0.6 should be maximum. Unless where there is a serious drop down and we want to recover, then if you're trading the third one, it should be very far from where we placed the second and third. I will show you from the chart. Yeah. Then on 15%, this is like which time should I use to do it? This is like an estimation. Sometimes, of course, you can hit this percentage in a week, but this on monthly cumulative. So 15% return on the derivative is classified as medium risk. While 15% return on mutual fund and other market is classified as high risk. Yeah. So each market have their risk. The way you trade it, if you make 15% return on mutual fund or treasury, 15% return is even sometimes the annual return, not even monthly return, because of the nature of their market. So it's not too risk, so the return is low. I mean, they have so maybe I may send this back on the channel. You may grab it and have it then, but if you can still have this one for the sake of information purposes, sorry, education purpose. Miss, is it only women that are trading? What of guys? Guys, no, they trade. No guy will tell me
So,
say they trade in this market.
please let me clarify something for what you said. So this one is a $1,000 account. So if the account is 2,000, all you need to do regarding the volume or the lots, you can now, for 2,000 to be 0.06.
Yes,
You can use up to
yeah.
about have 3,000 in the balance. Instead of asking, what should I, getting confused, not knowing what lot to use.
Yeah, you can say 0.6.
Yeah. So for on
Yeah.
3,000, so the more the money, the more
The more the volume.
the
Yeah,
volume.
yeah. Mm.
At what point
Like,
can you use one? As in,
sorry?
at what amounts can you apply one? Like not it will be okay,
One lot size.
1.0. One lot size.
Two things
So
happen
that
on that thing.
on 5,000.
One, two things happen. There are some market condition that is almost like 90% sure.
Yeah.
You see that one? That one, would they take high risk on that one?
Okay,
You know
it's
what
a
I
high
mean?
risk.
Yeah, yeah. There are some market condition that almost like 90%, like this one, like what the casual banker. You know what I mean? You see that one
Okay.
now, let me be honest with you, even me, I used to increase my risk.
Maybe for a short period of time.
Yeah, you know, there are some market conditions that even if you see some market, I will show you, but probably you're on 6 months trend. Within that 6 months,
Yeah.
we'll definitely gonna identify one or two. Something will just happen. Market will be like, you know, obviously this market is like is
Have you
good for you, but yes. So on that note, we try to like increase our risk a bit. So me sometimes kind of if I have $1,000 account, I'm even use one lot.
just for that one?
Yeah, one thing about it is that the money I invested, or I invest in trading. It's not money for my essential stuff. It's not money for my health, my health bill. Although I have an insurance that covers my health anyway. It's not money for my house rent. It's not money for my maybe power or food and all of that. And it's not money for my savings. It's money for my investment, and I expect anything to happen.
Okay.
And that anything is not that I expect liquidation, but I expect to make good return. But where we need to be careful with people is that when people tell you that this money is money for investment, actually it's money that is meant for saving. They now come in and it's the money, the value of investment just go down. They began to panic. You see that money is important, is not meant for that kind of in that kind of investment. Like yesterday, I invested money in crypto. I know how much I invested, and I don't care about that money. But I know that crypto can be funny. So if I woke up next week, discover that the so-called
Money is
crypto that
gone.
asked me to buy, yeah, it's done. I won't bother. I thought yes, I will say I talk and say this thing is, let me just put this one there and see how it's gonna happen. So that's how investment work. But if the way the guy told me about it now, by next week or 1 month time, the thing go up, I'll be happy. Say, yeah, okay, this works. Do you understand? Yeah, that's one thing about investment. So when we see some certain kind of market condition, we tend to take high risk. Like here, I'm not showing it again, but let me check. Until we reach 3,600 capital here. Okay, let me check. I think from account of 3,000 is where you could be able to start applying one lot.
One lot. Okay.
Do you know why? One lot give you like $1 per movement. Let's say your maximum stop out is 30%. That's what you can bear. That 30% is 300, which is 10% of your 3,000 of your money.
Yeah.
That maximum means that if this thing lose my money up to 10%, I will stop trading. So which is 300, and 300 is 10%. And if you're using one lot for movement, what the market have to go against you 300 pips for you to lose.
For you to lose.
So yes, for you to lose 10% of it. But now, if you say you're looking for 30% maximum, that means $900 is a maximum. So if you can bear 30% risk, for you to lose $900 with one lot, that is 900 piece, which is not common in the market.
Yes.
Which is not common. For you to happen, it means that particular instrument is having crisis. If it's underlying asset, it means it's seriously having crisis. For a market to go 900 pips straight, 900 to give him another 900, it's not really possible in the market.
Okay.
Do you understand the possibility now? Yeah. So on that note now, you could say, okay, I'm using one lot. Then it can put your risk in your mind, maybe 20% to 30% maximum stop out. It means anything that make my money to lose 30%, my equity to drop 30 up to 70%, which is 30% drop down, then you can stop trading for that entire instrument.
Yeah.
Yeah. So from there, you see that the emotion will not be too high again in the market because you're not too emotional. Yeah. Did anyone have something else to say? Anyone
Would you advise?
something else to say?
Okay, yeah, I started you. I think it's yesterday. I lost $4.
You lost $4.
Yes, I started. I think yesterday. Trade access.
I wasn't online yesterday much. Maybe it could be our assistant who chatted. On which of the instruments?
AU. Not sure what I'm
So I can't hear you. Your voice is very much down.
Okay, the trade is Euro US. Euro US.
Okay. Where did you put your stop loss then?
It was the number you asked me. You know, I'm just new. I'm a novice actually. You asked me to put it, I think 0 point something, which I did. And it's that day we traded, it was making $7, but you said we should just leave it open until you ask us to close it. So by the time I checked it there yesterday morning, it closed itself because it has reached the maximum loss that you asked me to place it, and so I lost the money.
This is a Euro USD chart. I hope you can see my chart.
Yes. Yes.
I think you are not in a quiet place. I've muted you now. So if you want to talk, you can unmute. Then I'll later. The market is still valid though. Maybe I put you on a closer stop loss. I don't know how much was the balance. Is it 500? No, $4. This thing is too close. It's closer. The market is still valid. Look at it. You see, this market is still very much valid. Do you understand? Because we bought somewhere here, 1.07 something. We bought somewhere here. We bought within this point. I think. We bought within
So
this
what's
point.
the way forward?
Wait, I'm making the analysis. We bought here that day. That was on Tuesday. This is Wednesday market. This is Wednesday market. Okay, no, we bought here. This is that Tuesday market. It went up. This is Wednesday market. It went up a bit. Okay, probably it was when it came down here. I could not have asked you to push $4. It looked closer. It looked too close. Because it is still within the same range that we bought it. It is still within the similar close range. So our stop loss used to be after the support zone. Like here now, after the support. I don't know who can remember. That was where I was emphasizing about stop loss. Maybe it's either a mistake from me. I don't know. It could be my mistake. Or probably you put it where they not confirm it properly. Because that $4 is almost like where we place a trade. Do you understand what I'm trying to say now? You are making $7 on this one that just went up and it came down, then you have -4. It stopped. So it's kind of so close. Maybe it's my mistake.
Okay.
Or your own mistake, because our stop loss used to be below. I'm trying to mute you. Don't worry, don't talk again because you're in a noisy place. So our stop loss used to be after support zone, after support level. We don't like to put stop loss closer because our aim is not to close that trade at loss. Now, basically, the Euro USD is also good in the buying area because look at the reason why I say so. It has not broken this support unless if this sell continue and break the support. If you break this support and probably hit down to maybe 1.06, then we should prepare to buy again. That's what I'm trying to refer with Mrs. Antonia about a second buy where we can use bigger.
Okay.
Because if market dropped, it does not mean that we should now change and start selling. That's a very bad mistake because by any chance that market started reversing there, you'll be losing from there. There are people that like to chase the market. It's dropping, they change and start selling. It's rising. They stop their sale and start buying. Before you know what's happening, the market may just start reversing from there, from that higher price. And before it will go back there again, it will be a problem for them. So now, when we place a trade with a small volume and the market dropped, let's say past 1.06, yes, we'll be losing, but second support, it may reverse, or before that one, it may reverse. Then we can now use another bigger loss set and place on it. Yes,
Okay.
so the lower one will now start gaining. Remember, it is still trading within our risk measure. The lower one will be gaining more than the other one. I don't know whether they will allow me to share my page. Maybe by next week, I mean, ask for permission to be sharing some of our accounts we are trading so that you see how we place them. Because I think I've not shared live trade with you. I will start sharing from next week. I will ask for the permission. So that those accounts are big accounts, so we're not allowed to disclose them anyhow. So okay, let me even know if I have a small account here. So now today we are trading crude oil inventory. I think you can see my chart. We are trading crude oil inventory today. Today is Thursday. Yesterday the market was not probably. I think there was a holiday in the US on early this week. So that's why the inventory report is coming out today. And now, that report is coming by 4 in the next 2 hours. So we may not be on the Zoom till that time, but we have to analyze it and follow ourselves on the chart. One, they are already expecting that $2.8 million will be 2.8 million barrel will be the outcome. That's what they're expecting already. So exactly by 4 o'clock, we'll check what is the outcome and know whether it is according to expectation or not. Last week on, if you check last week on was much, let me check. Last week on was around 3.7 million barrel. It was a build up. Why they expecting that there will be a shortage. Then when you check the market on oil, the price is already high, so it has broken this support, this resistance here. The market has broken this resistance. So based on law of support and resistance, if resistance is broken, it may push more further. It may push more further. Yeah. Then if that report is out, oil may rise more. If it's out, it may rise to maybe 81 or 82. However, it's not all the time that if market comes out like that, we trade it. If what was like a shortage is smaller, it's not too much, like last week was 3 million, and the price of oil is high, we may not buy further. We may find opportunity to sell because our second support is at 84. And the highest oil price on WTI is around 86. Notice what I'm trying to analyze now. Let me hear from guys. Guys are very quiet in this class.
No, sir, please take it again.
Okay. I'm saying something. I'm saying something that by 4 p.m., inventory report is going to be out. And last week, we had 3 million. That was like a supply of 3 million. And this week now, like today, the expectation is that there will be a shortage of minus 2.8 million shortage. Now, when you check the price of oil, it has broken this support, this resistance, which was $80 per around $80. I mean, it just broke it now. The resistance is 80.58. So the market is at 80.80. So it has broken this resistance here. Another resistance we're looking at is at 84.17. So what we're saying is this: based on a lot of support and resistance, if resistance is broken, the market will move more further because it has broken what was resisting it. Do you understand? Then if the market is also coming down and break a support, it may go more further because it has broken what was like resisting the support from the price from falling further. But once that level is broken, then that market may fall further. So on that note, we may say that since this resistance is broken, oil may go much up a bit. Now, if it's up like that, even if there is shortage in supply, we'll have to be very cautious in buying at a higher price. Do you understand what I'm trying to say?
Yes, sir.
Yes,
now it's going up, but it has not really formed any support zone, so any resistance zone or any reversal, no problem. Now, if the report is low, like what is outcome, maybe it's just a short decrease, we don't care. We may not necessarily act on that buy because what was supply is not much. But if it's maybe we're seeing like about minus 4 million supply or 3 million supply, about 4 million shortage, 3 million shortage, like bigger shortage, then it may move the oil market a bit higher. And at the end of the day, we should try to exist as quick as possible, maybe around 80. Like because of the price already is at the higher side. Now let me check. Okay, let me check this one. This is 84. Let me check this one. This is 80. Okay, this is Brent. Brent is at 84. Brent is at 84. WTI is at 80. Yeah. And the highest price of Brent was 90 this year. So we'll be checking what is going to be the outcome exactly on by 4 p.m. Someone sent me too. Who's me too? Someone said at Euro NZ. Okay, I understand. For me, we didn't analyze that Euro NZ. I don't know where that analysis come from. We did not analyze it. Now, that will be the what we should be expecting on oil exactly by 4. So we will drop that signal in the channel immediately it comes out. We'll drop it in the channel, and you should be able to trade it.
Sir, can a 1,000 account trade it?
Yeah, sure. 1,000 can trade oil. Why we don't like 1,000 on gold is because of spread.
Okay.
Yeah. 1,000 can trade oil. 1,000 0.1 is 10 cents. 0.2 is 20. 0.01 is 10 cents. 0.02 is 20 cents. It's okay. Do you understand? Yeah. It can,
0.0. Okay, 0.02 or 0.03 according to the plan.
Yes, it can trade oil. Yeah. So because of you are on a medium risk, so 0.03, 0.02, 0.01 is okay. on oil. Yeah.
With an existing trade, because this my
Sorry?
euro USD. I say even with an existing trade, can it take it? Because my euro
How much
USD.
are you losing? How much are you losing on Euro USD?
Let me open it. About $20.
No, you can
18.
trade it.
It
You
keeps
can trade
going.
it. Yeah, Euro USD is nice. It's not really bad for now.
Okay.
Do you understand? I wouldn't. We don't place a trade and close it, even when it's losing. We give it chance. Yeah.
Okay.
So if you do not reverse this week, most likely
Mm.
it will reverse by next week. Yeah. Because what happened on euro is a sharp drop on dollar. Dollar had a sharp
Okay.
drop. Look at the chart. The chart just from here fall. So the market may go back to where it's coming from. Look at it.
Yeah.
It's not. It's
I
not
wanted to
here.
ask. I wanted to ask that because when I checked it, I noticed I entered at 07334 and it's below. So I'm asking myself, the further it goes down, is there any hope for it to go up again and exceed even your entry points, or
Yeah.
it will remain down for a long time? Can it go back to the former price or a higher price?
Where do you say you enter? 0 point what? 1.07.
0.34.
1.0734.
Yeah, 1.0734.
Uh,
3334.
yes. 1.07340 or 343, which is
Yeah.
here. No, yeah, you have chance of going up. Don't even bother that one.
Okay.
Yeah, don't bother. Remember here, can you see the reversal candle here? Here is a reversal candle. So that in the form basic of support. So this support has not been broken. So it's possible that we may experience rise from here
The
like
support
this.
is even double now. I don't know why your one is not showing double.
No,
On
I'm
my
on daily chart. I don't know whether
okay.
you're on 4 hour
1 hour,
chart.
1 hour is even
Okay.
double. Support is double.
So there's one thing that happened in the market that this law in physics a lot of elasticity. Like if you have a spring, then and draw that spring, draw it. So when you leave that spring, then it will compress back to its original position. So if you check an euro dollar, it's been up for a very long time until there's this sharp drop on dollar, or a kind of sharp drop on euro USD that happened last week. Yeah. So now it's most likely that if anything that is making dollar to gain strength, once that eventually left, like the effect of it leave the market, then
Go
it
up
will
very
go up. Yes, that's why it
see
has
that,
formed a support.
yeah, that long green candle.
Yes, because of looking at their market by looking at it already, you see that it's up trend this year. It's been going up. It's similar to pounds. Pounds has also been up trend for a very long time this year. So all these things are like market wave. Sometimes the economy can fight back, but at the end of the day, it has chance of continuing its own uptrend as case made. So leave there. Where I can ask you to close your market, if it's even possible, is when market has defied all strategy, all analysis. We now know that one has failed. Then we continue another one. But if it has not, we don't encourage that thing because patience is the key. If you close that market now, it may start like rising again. Then we will not begin to regret it. So I wish. And of course, on this kind of market, I can't ask you to sell. And nobody that knows how to trade will ask you to sell. On
So
Euro USD, nobody that knows how to trade will ask you to sell Euro USD. Unless there's a strong fundamental that support that sell. A very strong fundamental, yeah, that support it. If you use harmonic scanner, any kind of whatever, and scan this market indicators or whatever, it's most likely going to point you to uptrend. It's most likely, yeah, it's going to like give signal for buy. So now, you definitely gain the market. Don't worry, you gain it. If you didn't gain it, I'll get another one that you used to gain it back. So yeah, then I think our goal is still okay, but gold, the gold price is not really the gold volatility is low, but it's actually at the right position where we place it. So all eyes should be on oil. We try to manage this cloud with AI. I wanted to show you those of us who are trading how we can be able to be navigating into AI trading or automated trading. That's how we could easily make more money while trading, and to avoid unnecessary mistake we are making. Yes, learning it is good for you to understand what AI is doing. Like in our company, the AI we use, we adjust them all the time, even though it's AI. But when we check it, because of we have experience about trading, then we keep adjusting them to act according to how we want it. Do you understand? Yeah. So that's why as you're learning it now, we'll give you a lecture on AI, but because of time, I may not give that lecture again because this is 2 o'clock already. So I may not give that time for AI. It's only by 4. I will come back maybe around maybe 3:45, 15 minutes to 4. I'll be on the live chat. So if possible, I may also be on the Zoom, but everybody is not mandated to join. In case someone wants to talk to me directly, do you understand? Yes. Yeah. It's not mandated that you must join, but I may also connect to Zoom. The same Zoom. I may just on it in case anybody is struggling to place it or got confused or there's something you want to hear directly from me. Then I will be able to do it. Then from there, if there's any fundamental that will counter this thing, I will let all of us know. Do you have any questions so far? What's the name again? The person that lost $4. What's the name? Let me get that name from here. Tempo, yeah, Tempo. Tempo, you will get that market back. I will show you what to do. Either we place buy again on Euro USD. Yeah, you have to buy Euro USD again. Tempo. Yeah, I will tell you. Yeah, it's good buying it at a lower price, but let me watch out more. If it's gonna drop further to this price, so if it's gonna drop further to this price, then you will buy more. But even if you show more sign of reversal, I will ask you to buy more. The market is valid. I mean, our analysis is still valid. It has not failed. Yeah. So let me know if there's any question so far. Any question?
I don't know about others. For me, I don't know that GBP USD. I think it would have been a good one for you to give us analysis on, so that anybody that wants to trade currency can just trade that one. I think I would. I have 2 accounts. I would like to use the other account to trade it.
But the way GBP US is forming is coming back to support zone here, but I'm trying to watch this market. You see this particular one that's coming. I don't know whether it's going to break the support. I've seen it, but I don't talk strongly on it. Let's also watch out. The same thing I said, let's watch out on Euro because the market goes the same time. Sometimes when the Euro US is dropping, JPY US will drop because dollar is the one leading at that time. So now the way it is going down here, if you get to this point, this place now, and they're not showing the sign of reverse, it means it will break this particular area.
Okay.
But if you show any sign of reverse, Euro US may also show the same sign of reverse. So it can be most likely be that we will buy JBP USD and buy Euro USD. But on a proper long-term analysis, we'll pay more attention in any buying signal on JBP USD. We'll pay more attention on any buying signal because of their market this year has been uptrend. Yeah. So let's be looking at within this 1.26376 within this time around on JPBUS, but not now. I would drop the signal on the on the group if there's a need for us to buy it. However, there's other instruments we can also bring out. It's not just only these two instruments. So if I see other instruments that have potential, I will drop it again in the group. Anyone can be able to trade on it.
Yeah, that would be nice.
I think this will be where we will close for now until 4 o'clock. Anyone that has that have chance should just come back again. We'll trade oil and see what's gonna happen.
So,
Any other question?
sorry, one more thing. Yeah, one more thing. I was given this. Okay, they even dropped it on the group for us to open an auto account with GFT.
Yeah. Yes. Yes. I'm a hedge fund manager, and I trade one of GFT accounts. I have about 4 brokers I trade on for them. I don't want to mention their name here because I'm not promoting them. Yeah, but they are big companies. 2 companies in Nigeria, I trade for them. Sorry. So on GFT, it's also a trending brand. And they are under AvaTrade. AvaTrade is the one who provides them everything, financial service and everything. So you could be able to join the auto trade account on them because of everything that is powered by AI.
Yeah.
You understand? Yes. So now, as we are making profit here, you're making profit there. All you just have to do here, you click on open account. But if you have account with Ava already, no need to open account. You just have to connect directly from Ava to them. So no need to sign up on their website again, but you already have account with Ava. So yes. Sorry.
I already opened. They sent me that link from the WhatsApp, so I opened.
Yeah, even if you open, there's no problem unless you want to fund that again. But if you have account with Ava and you want to use that same account, then you can just connect from Ava to them.
Okay.
So they have AI and a hybrid, and we discussed with them. People under our trading school, they're not going to charge them performance fee. So any profit you gain is as good as it's almost as you gaining it by yourself. So you're going to withdraw your profit 100%. Nobody's going to touch it. Do you understand? So it's not that somebody maybe normally they used to charge performance fee on each trade, on each profit, but any profit they gain for you, they are not going to take the money, so you can withdraw it. Then they can manage a very big account for you. I also want to make it clear. I don't want anybody that has big account to trade for herself or himself again, unless if you have enough confidence. Because of vulnerability issue, it's painful when you lose big money than when you lose small money. So that's the truth. Yeah. So we can use you can use GFT to make good amount of money if you want it. So this year alone, they have gained more than. Let me check on their website. They have gained more than 170% profit already. All these things you cannot gain it in equity market in a year. It's not possible. Or even if you gain it in real estate, then it's not possible. So you can join them, connect an account. You can connect as many accounts as possible. That's AI, that's hybrid. As you can see from the investment banking course, how those things are structured. Money pass through those companies and come to traders. That's how things are regulated. So AvaTrade, for example, have pool of big money that's coming into them, and they diversify those things to companies who are already trading with them. Then you as an individual person can also trade. But there are a lot of companies involved in dealing on all this, in trading for all these companies. A lot of big companies managing those funds.
Okay.
That's how it works in everywhere. Both the company we have in Nigeria, we have a regulated asset management company in Nigeria. If you want to use them now, they're not going to open any account for you. You have to open an account under them, fund that money under them, they know what to do with it. At the end of the month, end of the year, based on the contract and whatever thing that comes out is what you will be able to get. You don't understand? So don't panic. If you want to join them, join GFT. If you have an account with them, yeah, it's also a very good automated system. And the hybrid is that hybrid is not 100% automated. Hybrid has manual and auto and connected to it at the same time. And their trading system is good, mostly on commodities.
Okay.
Yeah, so they be trading one account, then you can be trading one. Any questions so far? I think that's all for now. Let's wait till 3:45 to 4 p.m. today. Thank you and have a lovely Thursday.
Okay, thank you, sir.